American markets tanked yesterday over fears of the new tariffs for Europe and the conflict about Greenland. Today, they stormed back. Let's go to Tim Chubb on this. He's Chief Investment Officer at Girard. Tim, thanks for joining us today.
Thanks for having me.
So clearly investors are watching these events with, I guess, nervous energy around them. What did the rebound today tell you?
Yeah, I think it was ultimately what we, had seen a couple times, throughout most of 2025, and that many times when the, Trump administration, puts forward some of these policies or these threats related to tariffs, that ultimately it's to get to the negotiating table and hopefully use that as, somewhat of a leverage to, affect some of the changes that they want. And so, I think markets had sold off, earlier in the week as a result of, obviously that uncertainty and the threats, especially related to the European Union and the trade path there. But I guess it's a sigh of relief since, as the just being mentioned, we haven't necessarily seen, that strong of earnings this week, at least this far.
I was going to ask you about earnings in a moment. I just want to see, first of all, if you see 2026 as a year of growth.
We do. I think ultimately the U.S. will settle in, close to trend growth. 2025 will most likely look like a, 2% real GDP year. 26 is looking, increasingly like, 4.5% nominal GDP growth, which I think is a pretty nice environment for stocks, given the earnings growth expectations that, are expected. But, ultimately there are some, signs of slowing within the labor market, which I think will leave the Fed, giving them some evidence that they can continue to cut interest rates later in the year. It's a cooling, not cracking, situation, but the labor market is nonlinear when it tends to move, and ultimately it'll be something we'll be closely watching as we go throughout the year.
What early hints have you taken from earnings season so far?
Yeah, I think, ultimately Bailey had just mentioned quite a bit about the consumer names, and we'll get many more, later in the quarter. But you're really seeing the U.S. consumer, start to be a bit more discerning with how they're spending their money. Whether it's, the spices on the McCormick side, as just, previously reported, and going to some of the off-brand names. We've definitely seen, even from some of the retailers that just reported, just a few weeks ago from fourth quarter, like Walmart and Target and the like, that, even some of the higher earners are ultimately spending a bit more discerning and on some, sort of value-oriented products. So, unfortunately, a lot of those names are being challenged by tariffs from the bottom line standpoint, but they're also being challenged by tariffs on the top line as well, given how fatigued the consumer has been with, pushing through these price increases.
Okay, the big tech companies, of course, we have yet to hear from. What do you expect as a theme from them? I know Intel's going to or is reporting after hours, but generally speaking, what do you expect as the theme emerging from big tech?
I think, maybe it's a oversimplistic answer, but, I don't think very much is going to be changing. Investors will be looking for, AI monetization, what expectations are going to be looking like on the CapEx side of things. Some of our favorites, like a Meta, obviously have been seeing some of the early efforts on the AI spend result in ROI for advertisers. And so I think it continues to be, very, for the Fed, it's the labor market, for the market, for the stock market, that is, it's really what's going on with this AI CapEx spend. But I do think a theme that may start to occur throughout the rest of this year, which should be supporting those CapEx figures, is really the enterprise adoption taking place with generative AI. For much of 2025, it was a lot of, let's make sure the data is secure. How are we going to roll this out to our workforce? And so a lot of the software names, like a ServiceNow, for example, although it's per seat pricing, I think will continue to benefit from, sort of the vertical, software as a service model, and being able to monetize some of those AI investments to their customer base.
Okay, so let's back that up a bit, because obviously those who have the enterprise AI benefit are going to backtrack to where the AI growth comes from originally. So who are the AI winners and losers that you see now? Is that becoming clearer?
I think it's becoming clear, throughout this sell-off. It's been interesting. There's been companies like Microsoft that are going to be really well positioned, that have sort of been the software names, babies thrown out with the bathwater, if you will. But there's other companies out there that have quite a bit more terminal risk associated with how AI could potentially, change the entire dynamic for, the product that they're servicing. And so from a software standpoint, I think metered rating and consumption-based models perhaps will become a bit more popular versus the per seat. But for some of these mission critical software needs, especially on the enterprise side, like a Salesforce or a ServiceNow, we think they'll just be fine after all the sell-off is over. And so we've been, incrementally nibbling so far this year on some of those companies. And I think they'll ultimately be winners that are getting priced like losers right now.
Okay, let's get to sectors that you like more generally right now. I know you say you do have to be more picky as an investor.
Yeah, I think financials is an interesting place to look. Early, in 2025, we had taken off some of our exposure on the banks as the yield curve, was getting priced in and steepened. I think, we'll continue to see deal activity remain strong for the first half of this year, as we've seen from some number of the banks thus far. But leaning away from the banking sector or industry group in particular, really like some of the rating and agencies, the data analytics businesses that do have some AI beneficiary elements to them, but overall have just gotten, I think, mispriced by the market. So we're thinking of names like Moody's and S&P Global that will continue to benefit from, ultimately what should be quite an interesting, first and second quarter from an issuance standpoint in the debt markets, both in investment grade and high yield. And so, their pricing power and high incremental margins really make their earning streams resilient and ultimately command a higher multiple as a result. I was going to mention the payment side of things with Visa, given some of the credit card headlines recently, has been another area that we've been leaning into.
All right, Tim Chubb, got to leave it there. So thank you for your time. I appreciate it.